Time to get defensive on U.S. equities. Let's bring in Jason Pride from Glenn Mead and Barry Knapp from Ironsides Macroeconomics. Guys, it's great to see you. Barry, to you first. Are we putting together something here to build on, or are we just thinking of false hopes?
No, I let off Squawk Box a week ago Thursday and described how these Fed policy normalization related corrections are really your second best window to put money to work if you didn't buy the lows of the recession. So if you think back to the end of QE2 in 2011 or even QE1 in 2010, these drawdowns on fears that the Fed's going to be tightening into a slowdown are generally way overdone, particularly early in the business cycle. And these are great entry points. So I thought there'd be a 12% forecast, which is the average Fed policy related correction this year. We went to 20, which is on the outside of those. It's as big as the one in 11 or the one in 18. But at this level, we'd have to have a deep recession. The median decline for recessions is 24%. We'd have to have a deep recession to justify further downside in particularly in cyclical sectors. So I think this is the start of the recovery from the Fed policy normalization correction. Wow.
Jason, do you buy it? Do you believe what Barry has to say?
Look, Scott, I think actually this is a little bit harder than that. We started at higher valuations, so the possibility of a decline being a little bit deeper is a little bit higher. We are now in the late stage of the economic cycle. Late stage tends to come with it lower returns for equities, rising yields, and better returns for fixed income. Makes fixed income more competitive. It means you need to have a more balanced portfolio rather than just riding the equity wave. So we've downshifted risk back to neutral in this environment, and we're waiting for further indications that there's actually a recession coming, because truthfully, late cycle can actually last a long time. And we want to be positioned to ride that out if necessary, but we also want to be ready for the potential recession if the Fed does take this too far, which I think is definitely in the cards as a possibility at this point.
I mean, Barry, do I hear you saying that you think a bottom was in as of last Thursday? Now, remember, you look at where stocks are today, and you remember where they were on an intraday basis a week ago at this very moment. I mean, the S&P at 3810. Here it is at 4135. The Dow at 30,635. Here we are at 33,000 and trying to hold above that level. Are you calling the bottom?
Yes, I do think that the bottom was in, and I'll tell you where I disagree with Mr. Pride a little bit around the stage of the economic cycle we're at. I thought the pandemic was two things that the global financial crisis and aftermath was not. That global financial crisis was a deflationary shock. This was an inflationary shock. Okay, that's been clearly proven. But I also think the global financial crisis was a negative productivity shock, and this one was a positive productivity shock. That's part of the reason why margins have held up as well as they have. For all the concerns we have about retailers, by the way, margins in the consumer discretionary sector are above cycle peaks for the last 3 cycles. So I think that the productivity part of the story is going to become evident in the second half of this year. And it ultimately will mean the Fed can raise rates farther than expected. But the real limiting factor on how far they can go is federal government debt, not private sector debt. That's a very different dynamic, and it implies that we're not close to the end of the cycle.